Hello, welcome back. In this video, I wanted to take a look at WWE, World Wrestling Entertainment stock. Now, many people may not have thought of potentially adding this kind of stock to their portfolio, but over here in this channel, we examine all sorts of companies trying to figure out which ones are hidden gems. Now, is this one a hidden gem? If you take a look at the 5 year chart here, you can kind of see that it has been sort of like trading at a range of about 40 to 90. And we are sitting at the high of that range, near the high, 80, almost $82, where its 1 year high has been 93. So the good thing is that somehow this hasn't gone down a lot. It's down only 12%. So generally speaking, again, you can kind of see the 5 year chart. It has been doing pretty great since 2020. At least the stock price, that is. Now we will examine the business because that's the most important thing. And you can kind of see here in the Marx chart that the company has been flying near 2020, 2018, something of that sort. And then it went down and sort of like picking up again. Interesting. But we will examine this company in regards to its financials and also what is actually going on with the business, because that's very, very important. I remember watching WWE as a kid, but is it still relevant? We are going to examine that. And also some very interesting news pieces about what the company is preparing to do in regards to betting. I wanted to take a look at that because that's extremely important. Now, the P ratio of the company is sitting at 31. And the price to free cash flow at 48, up from what they used to be back in 2020, both of these. So it's getting a little bit more expensive here. But these values alone are not enough to exclude a company from buying it for a portfolio, of course. Now, the outstanding shares, it's nice because the company has been buying back just a little bit of shares. And the total abilities that the company has compared to the free cash flow are a little bit more than we would like something like 5 and below would be great here. But it means that the company requires about 6.6 years to pay back all their total liabilities using last year's free cash flow if they wanted to. So basically pretty solvent, but it could be a little bit better. Now, the revenue growth of the company and the net income growth of the company have been picking up, as you'll see, since 2019. But the free cash flow has been going down. So this is something that we want to examine and see what's the cause of this. The total equity growth, which is also very important, has been going up without the company actually issuing shares, which is nice to see. It's coming from profits. So that's very nice. Now you will see here that the company has a little bit more debt than what I would like to see here. Quite significant amounts over here, 1.8 of its equity. That's quite a lot. So, but its equity, it's not that high either. Like remember that in regards to absolute values here. Now, the company is also paying a dividend. 0.7% is very little. It is a relatively high payout ratio for what it is, for 0.7%. And also in regards to a net income ratio over here. But you will see, if you take a look at our tool here, at our dividends tab, the dividends tab here, you will see that the company's dividend has been flat. So they have been paying the same dividend over many, many years. Now, it's nice to have, I guess. It's not bad, but it's not about the dividends. This company is the point. We will examine the financials just to see the finer details. We need to see what is going on with the company through the years. Now, almost $1 billion here to 1.3 in 2022. So as you can understand, there is some growth, but not enough growth. The past couple of years may have been a little bit better, as you'll see here in regards to growth. But the company has been growing at an okay rate, I'd say, but not too high. Even though they are sitting at $1 billion in terms of revenue, which is, of course, not that high. When compared, of course, to bigger businesses, that is. It's still $1 billion. But you will see here that the net income of the company has been increasing as well, from 100 million to 200 million. So that's doubling. That's pretty nice, actually. The numbers are low on what the company is actually making in absolute values. But if you're having a company that keeps growing and growing and growing, and they don't have a lot of debt, and the stock is cheap and all that, it's still a potentially good buy. You don't have to buy behemoths for sure. Like there are other companies that are still great and making lesser money than all these huge companies that we're talking about in the channel. So from time to time, you will find these kinds of companies, but of course, we're not sure if it's a buy yet, that is. Now, as you'll see, the total equity has been growing as well without the company pretty much issuing shares, which is nice to see. And the cash flow statement, the important thing that we wanted to examine here. So you will see that the stock-based compensation, for instance, here has been picking up a little bit when compared to the previous year, for example. And depreciation and amortization is also a little bit more here. Now, When all these are accounted for, the operating cash flow is at about $325 million, which is exactly what we would like to see. Higher operating cash flow is very, very important. Now, 2021 wasn't great, but 2022 much, much better here in regards to operating cash flow. Now, the big thing and why the free cash flow has been going down is the capital expenditure. So they're spending money. Now, does this have to do with what they're preparing in regards to betting? Maybe, but they're spending way more than what they used to in the past. Now, this may be a good thing though, because when you're spending money on your capital expenditures, you're looking to expand, like you're spending it in your operations, it's capital expenditures pretty much. So it's not like you're having debt, for example, which is nice to see. Now they're paying about 35 million, 36 here in regards to dividends. So that's pretty much every year. And the free cash flow, again, 154. Now this is lower, but again, remember this has to do with the capital expenditures, because if this was at the range of about 40 million, then we would be much, much higher here. So we would be at about 200 million or more even. So you're looking at this, but you need to examine the finer details on why this is happening. Now, what about the company in regards to its value? Like, is it a company that's worth buying compared to the actual stock price right now? For this, we're going to use our discounted cash flow model, pretty much our stock evaluation too. But before we do that, before we jump into that, which is very, very interesting, and see what the company should sell for in regards to its stock, let's first take a look at what is going on with the actual ratings in WWE. So I was taking a look at different articles, and I found this very, very nice breakdown of how the ratings in WWE are the lowest in 20 years. So you can kind of see here, back in 2000, where the company actually was at a very nice peak, you'll see that it was at its high here, and then every year it's lower and lower and lower. And again, this is 2017, for example, so that's 6 years ago. But if you take a look at the overall metrics and other articles that I was taking a look at, it keeps dropping. So you can see that there is a decline here in regards to viewership. And so this is very, very important. Now, WWE is in talks with state gambling regulators to legalize betting on scripted match results. That's interesting. So I don't know how you're going to bet on scripted match results, because obviously WWE is scripted, it's a show. And there are discussions around this one. Now, I don't know how this could potentially work, but the point is that if that does work and if that becomes a thing, then it's a potential stream of revenue here, and it could be a very high stream of revenue. Now, the thing that we don't like about WWE is the fact that it's getting obsolete. Now, you will see here that WWE employees are rolling their eyes over huge possible company changes. Again, this article is talking about legalized betting on their matches. This could say a lot about the company, including when wrestlers find out who will win which matches and all that jazz. So, as you can understand, this has tons of repercussions about the company. But it could really, really help them skyrocket the revenue, especially amidst a season, a period where the ratings are actually going down. So this is the worst thing for a company, and this is the thing that I don't like to see here: the fact that their viewership is going down. Understandably, kinda, because we have so many media these days. Like back in when I was a kid, the internet wasn't a thing, basically. And so WWE and all these shows were huge, like everybody was tuning in to watch this stuff. But today we have so much media that it's getting more and more obsolete, is the thing. Now, it's still making revenue, though, and if they get it to legalized betting, it could make even more. So it's not like the company is dying, at least so far. Now, we do know that there is some risk because of the business, which means that if the stock is cheap, it's very cheap, then it's potentially worthwhile to take a risk. This is what we're going to examine in our tool here. You will see that the revenue growth of the company has been sitting at about 10%, which is okay, it's solid. So we're going to go 5, 7, and 9, assuming that the company could potentially even do better with their gambling pretty much, betting pretty much. Maybe this goes even higher. Maybe the revenue skyrockets. But let's just try these normal numbers in the case where this betting thing doesn't work. Now, the net income margins are sitting at about 15 to 12, 15, right? Recently about 15%. So I'm going to go somewhere near that, 13, 14, and 15. And the free cash flow margins a little bit all over the place, but we know why this is happening. It's because of capital expenditures and the likes. Now, we're going to go with something that is relatively typical for sustaining your free cash flow, about 80, 90, and 100%. And the annual return, 13%, is what we like to see, at least. And we hit calculate, and you will see that the stock price is expensive for what it is right now, at sitting at 81 bucks. Now, the only thing you could potentially justify a higher price is if the company will be growing at a much higher pace. Now, if we take it to our 10%, which has been the average, and you can kind of see it here, this is the breakdown, but the average has been 10% in the past 5 years, at least. If we take it to 10%, and let's just say 15 and 20, thinking that the company could actually do very well in in terms of their gambling thing, their gambling pretty much business, if this goes through, and we hit calculate with these values, we are still in the red, and even our 20% revenue growth still is in the red here, sitting at 79 bucks, a little closer, much closer, but still in the red. So the company has a kind of like declining viewership. The stock price has been skyrocketing recently, making it more expensive. So if this was, if I go back to our metrics tab, and if this was, say, around $50 and less, like 40 maybe, or 35 as it was here, for example, which is much better, then it could be worthwhile, adding a little bit to a portfolio. But right now at 81, things have to go really well for them and continue going really well over the years for you to be able to get a higher stock price. And I really don't like the fact that, again, when we examined our max chart here, it hasn't surpassed 100. Never in its history. That's the stock price. So, of course, that doesn't mean that it won't. But it does give you a little bit of the potential of the company and how traders and investors are actually trading it. So that's what I wanted to talk about. WWE, interesting. I used to watch it as a kid. The stock has been skyrocketing recently. But again, it's probably a little bit more expensive than what I would like. But thanks for watching, guys. Remember to leave a like and subscribe, of course. And I'll see you in the next video. Bye-bye.